Hi there, welcome back to Nepi Invest and welcome to a standalone video on Telstra. I'm not sure if I've done this before, so I suppose there is a first time for everything. Now, during March, one of the tasks I give myself is to go through the myriad or plethora of half-year and full results that were released in February. Thankfully, March tends to be fairly quiet when it comes to the most interesting type of announcement, which is a trading update. And the reason there's not many trading updates in March is because when a company releases their half-year results in February, they also tend to release a trading update. So they're not going to release another trading update 1 month later. So I do find the March is fairly quiet, and I do have a fair bit of time going through half-year and full-year results. Now, one of the half-year results that pleasantly surprised me was released from Telstra. Now, this was just on a brief glance. I had a quick glance at the results, pleasantly surprised, and it seems like the market was pleasantly surprised as well. Share price did pop up. So I thought, well, we're in March, we're in the period or time of year where I have enough time to go through some results, some financial statements, and I thought, since I thought Telstra was pretty good, let's have a look at Telstra's financial statements. So I went through their profit and loss statement, their balance sheet, and also the cash flow statement, and I did find a red flag. And this is a red flag that I absolutely hate. This is something companies do on occasion, big companies do on occasion that I really hate. I absolutely abhor. So I'm going to go through this particular red flag that I don't like. And then we'll also go through not only the company's half-year results, but also go back through time to see if this sort of red flag pops up for Telstra on occasion. And then we'll also have a look at a reason why this might have popped up in this particular half year. So even though it is a red flag, there is a justification from the company why it has happened in this particular period. Okay, so let's go back and have a look at Telstra's half-year cash flow statement, focusing on operating cash flow, capital expenditure, free cash flow, dividends, additional costs, and debt. Okay, so operating cash flow is found near the top, and for this company is 3.172 billion, which actually does include income taxes paid. Now, capital expenditure can be broken up in two parts: traditional capital expenditure, which is payments for property, plant, and equipment, also payments for intangible assets. I include the two. Some platforms don't. So if you go to FinChat, they only include payments for property, plant, and equipment in capital expenditure. But anyway, capital expenditure for Telstra in this half year was $1.97 billion, which means the free cash flow. So to get the free cash flow, you subtract capital expenditure from operating cash flow. The free cash flow for Telstra was around about 1.2 billion. I believe in their presentation, they mentioned free cash flow was a little bit lower than that. I think it was about $1.1 billion. So we'll just say free cash flow was about 1.2 billion. Now, the dividends paid in this half year was $1.1 billion. And because free cash flow and dividends are about the same level, the cash on hand must have dropped because additional costs, which include lease payments and also finance costs, are totaled $800 million. But you'll notice that the cash on hand for Telstra did not drop. And the reason it did not drop is because debt rose by $600 million. So another way to look at this is the company paid their shareholders dividends by increasing their debt. And this is something I absolutely hate, absolutely abhor. This is definitely not something that is sustainable for the long term. So I thought maybe this is just a one-off. Maybe this is just this is not the usual thing for Telstra to do. And maybe there's a bit of seasonality when it comes to the free cash flow of Telstra. And we'll talk about this later in the video. So what I did is I went back to the company's full year 2024 financial statements. And this is what I found. And using exactly the same metrics, operating cash flow, 7 or just above $7 billion. Capital expenditure, this is a capital intensive company. They spent $5 billion on property, plant, equipment, and intangible assets. So that means the free cash flow of this company was around $2 billion in this financial year. But Dividends paid $2.2 billion. So dividends paid were greater than the free cash flow. And that's not good. That is not good because I'm going to talk about capital allocation in the next slide. But that means the cash on hand has to have decreased because that does not include lease payments and finance costs and other costs, which total $1.3 billion. So if you look at the difference between free cash flow and dividends, about $200 million, and the additional cost, that's $1.5 billion. And then you have a look at debt. Debt increased by $1.6 billion in financial year 24. So again, this company paid their shareholders dividends by increasing their debt. I'm going to tell you right now, this is not a sustainable business model. Now, I'm just going to talk briefly about capital allocation, why this is important, and then we'll have a look at the history, whether this is something that Telstra does every single year, and then we'll have a look at a justification behind why this might have happened in the last half year. So let's have a little bit of a chat about capital allocation. So in my opinion, capital allocation is the most important job of management for companies that generate cash flow in their business. What are we going to do with this cash flow? Dividends, share buybacks, acquisitions, research and development, or maybe we just let the cash on the balance sheet increase through time. But it seems like Telstra management have decided, what are we going to do with this cash flow? Well, in fact, they have decided to do a share buyback. Acquisitions, no. Research and development, no. Increase cash on balance sheet, no. So we're going to give all the cash flow back to the shareholders through dividends. But not only that, we've got to increase the debt as well. We're going to use all our cash flow and increase our debt to give our shareholders dividends. Again, this is not a sustainable model moving forward. Okay, so next thing I did is I went back through the last 10 years. Now, this particular graph via FinChat looks a little bit, I wouldn't say scary, but there's a lot going on here. What I've done is at the top, the green bar at the top is operating cash flow. And on the bottom, I've included capital expenditure. Also, that's intangible assets or purchase of intangible assets plus normal capital expenditure. Again, the FinChat separates the two. Other financing activities, so leases, finance costs like interest, that sort of thing, and also common dividends. Probably the best way to look at this, by the way, notice operating cash flow has not increased through time. It's actually going backwards through time. That's scary in itself. But the best way to look or view this particular graph is if you have a look at the very top number, which is the operating cash flow, and then compare that to the bottom number. That's the most important thing. So when you see the bottom number, so down here, so for in financial year 24, that bottom number is negative $8 billion. When that number is greater than the operating cash flow, that means the debt must have increased in Telstra. And you've noticed a really interesting thing happening with Telstra. They've gone through 3 periods. If you look prior to 2019, that bottom number was always significantly greater than the top number. So that means the debt in this company was increasing during that period. So in a way, this company was paying their dividends by increasing their debt. But for some reason, their business model changed in 2019. And you'll notice the operating cash flow didn't change all that much, but the bottom number changed heaps. It went down significantly between 2020 and 2022. Significantly enough that this company significantly, greatly paid down their debt. But things have changed, and it looks like things might be turning back to the way they were between 2015 and 2019. That bottom number is now increasing, but the operating cash flow is not. And the other thing you'll notice is if you have a look at dividends, this company actually significantly decreased their dividends between 2018 and 2020, but they're starting to increase their dividends, even though the cash flow is not increasing. So maybe this company's management is going through a different phase where they believe they can increase their debt again. And the next slide, we'll have a look at the debt history of this company. And you see that here. So between 2015 and 2019, the company's debt was slowly increasing. But then between 2019 and 2022, the debt in Telstra dropped dramatically. And the reason it dropped dramatically is because they paid back on dividends. They decreased the dividends. They also paid back on capital expenditure. So the debt decreased from 17.3 billion all the way down to 10.8 billion. But what's been happening in the last few years? Debt is now starting to increase. And the whole reason it's starting to increase is because they're increasing the dividends, increasing capital expenditure, which means all that spending they're doing is greater than their cash flow, which means they have to increase their debt. And that is exactly what we're seeing with Telstra over the last few years. So there is a possibility they're going back to the way they were prior to 2019. However, in their presentation, they did have a justification for this. So they did mention that the free cash flow is seasonal. And I needed to verify that, and I'll verify that in the next slide. But they also mentioned here, or in their guidance, they gave free cash flow for the full year between 3 to 3.4 billion. In the first half, it was only 1.1 billion. So they do expect significant free cash flow in the second half of the year. So in a way, you could argue that with that significant increase in free cash flow, that has paid the dividends that they did pay in the first half of financial year 25. Now, to verify that free cash flow for Telstra is seasonal, let's have a look at the free cash flow half-yearly increments. And when we do that, you can definitely see there is seasonality here. I can see going up and down, and the first half here is always much weaker when it comes to free cash flow than the second half of the financial year. So definitely there is an argument that for the first half of financial year 25, the very fact that dividends might have been paid through debt could be justified, that there is going to be a significant increase in free cash flow in the second half of financial year 25. So even though I'm saying it is a red flag, and it is a little bit disturbing that we saw this in the full financial year 24, we may not see it in financial year 25. So one slight red flag I do have, and this is something to be wary of moving forward for Telstra, because they do have a history of doing exactly that, paying their dividends by increasing their debt. Okay, if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.